Hello everyone, here is a review video for Chapter 3 in AC243 that looks a lot like your Chapter 3 graded assignment. In our first question, we are Your Pillow Incorporated, and we're going to manufacture self-cooling microfiber pillows. We're going to experience $300,000 of total fixed costs related to manufacturing. We need to figure out what our break-even in units is, given a different revenue and variable costs under 4 different scenarios. We also need to figure out what our desired sales quantity is to sell in order to make enough to have an operating income of $200,000 related to the sale of these pillows. So in scenario 1, we're going to assume that we're going to sell each pillow for $60 and the variable cost to produce each pillow is going to be $40. The first thing we need to do is figure out what our break-even in pillows is. Well, that's easy enough. To find your break-even point, all you do is you take your fixed costs and you divide them by your contribution margin. So for break-even in pillows, we know from our information that our fixed costs is $300,000. We got to divide that by our contribution margin. Well, what is contribution margin? It is sales revenue minus the variable cost to produce each unit. In our case, $20. That's our profit margin on each pillow that we sell. So if we take 300,000 and divide it by that 20, we're going to have to sell 15,000 pillows at this given revenue point and variable cost point in order to break even. In B, what happens if, how many units do we have to sell if we want to make an operating income of 200,000? Well, if that's the case, all you do is you add your target operating income to your fixed costs. So we had $300,000 in fixed costs. We want to have operating income of $200,000, which means we're going to have $500,000 left over after we account for the cost of production. And we're going to divide that by our contribution margin per unit, which in this case again was $20, difference between sales revenue per pillow and variable cost per pillow. That comes out to be 25,000 pillows that we're going to have to sell at this price point and this variable cost point in order to earn operating income of $200,000. Moving on down to scenario 2, it's the same question, but now our change is what we're going to sell it for and how much it's going to cost us to produce. Well, now we're going to sell it for $70 instead of $60, and it's still going to cost us $40 to produce each pillow. So to figure out our break-even in pillows, we again take our $300,000 in fixed costs and we divide that by our contribution margin, which is equal to the difference between our sales revenue and our variable cost per pillow. At this price point, we're only going to have to sell 10,000 pillows to break even. How many pillows are we going to have to sell to earn $200,000 in operating income? Again, we're going to take our $300,000 in fixed costs, add to it our $200,000 of target operating income, going to be $500,000. And when we divide that by our $30 unit contribution margin, we're going to have to sell 16,667 pillows, rounded off, in order to earn operating income of 200 grand. In scenario 3, we're going to sell these pillows for $55 a piece, but we're going to lower our variable cost to $35. What's our break even going to be? Well, it's still fixed costs, and they don't change. Still 300,000 divided by our contribution margin in this scenario, which is the difference between our $55 selling price and our $35 variable cost of production, or a $20 contribution margin, if you will. It's 15,000. How much are we going to have to sell? What quantity are we going to have to sell to earn $200,000 in operating income? Again, that's our $300,000 in fixed costs plus the $200,000 in operating income we want, for a total of $500,000. And we're going to divide that by our contribution margin of $20 per pillow. Comes out to be 25,000. As you can see, scenario 1 and scenario 3 have the same exact answers. Why? Because the contribution margin is the same. In scenario 1, the difference between our $60 sales price and our $40 variable cost was 20 bucks. In scenario 3, the difference between our $55 sales price and our $35 variable cost, 20 bucks. So it doesn't matter as much what changes for revenue and cost. It's what your contribution margin is that really matters. And lastly, let's go on to scenario 4. What is our break-even in units for pillows given a $55 selling price and a $30 variable cost? Well, How do we figure it out? We take our fixed costs, still 300,000, and we divide it by the difference between our selling price and our variable price, which is our unit contribution margin. It's going to be 12,000 pillows to break even at this particular cost and this particular cost of production. How about to earn 200,000? Well, we need to cover our $300,000 in fixed costs plus the $200,000 in operating income, which means we're going to need 500,000 in total, and we're going to divide that by our $25 contribution margin. That's going to tell us that at this point we're going to have to sell 20,000 pillows to earn $200,000 in operating income. So which is best? And the answer to that is, there is no good answer to that. Scenario 2, we have to sell the least amount of pillows in order to break even. But in scenario 2, we're selling at $70 a pillow, and that's a pretty expensive pillow. Are we giving up potential revenues by selling at such a high price point? Like, would we sell so many extra pillows at $55 a pillow that we'd actually end up making more selling at 55 because we have such a larger sales quantity than we would at 70? It's one consideration right there. The other consideration, second best option, is scenario 4. That's got the lowest break-even, second lowest break-even point to scenario 2. It has the second lowest sales volume point to earn $200,000 in operating income because it has the second biggest contribution margin. Well, why does it? Because it has the lowest variable cost. And how do you lower your variable costs? Well, you can lower the cost of your labor, get less experienced workers. You can possibly lower the cost of your overhead that's variable. But the big thing to lower your costs is lower the cost of your materials. If we're going to produce these pillows for $30 a piece, that means we have to be having cheaper materials. And if we have, that cheaper materials, is the quality of our product suffering? Are we going to continue to have sales if we're using such cheap materials that our pillows are not performing as advertised or they're tearing? So these are considerations to have. So there's no right or wrong answer. We just have our points here for break even. In part 2 of this question, Your Pillow has decided to sell their pillows for $50 a piece, and they believe that the variable cost of producing each pillow is going to be $30. Well, how much sales revenue are they going to have to generate to break even and have net, not operating, but net income of $1 million? We are going to assume that fixed costs related to manufacturing are still $300,000, and that this company is going to pay a 20% tax rate. So to answer this question, we have to figure out a few things first. Firstly, we got to figure out what our contribution margin percentage is, and that is the portion of our sales price that's left over in contribution margin after we account for our variable costs of production. So what is our contribution margin in part 2? Well, we're selling for $50 a piece. It's costing us $30 a piece to produce each pillow, which means the difference between those two, $20 is our contribution margin. Our sales price is how much we sell each one for, which is 50. So what percentage of our sales price is left over as contribution margin? Well, you can figure that out by taking your contribution margin and dividing it by your sales price. And in this instance, that's 40%. 40% of our selling price is going to be left over as contribution margin. The second thing that we're going to need to do to answer this question is we're going to have to figure out, to get to that net income, our after-tax income, what amount of operating income are we going to need? So our desired net income in this case, in this problem given, was $1 million. Well, to convert that to operating income, we should divide by 1 minus the tax rate. It's given in the problem that we have a 20% tax rate. So if we have 1 minus our 20% converted to a decimal, 0.20, that means that's 80%. 80% of our operating income is going to be left over as net income. So to figure out what amount of operating income that's going to be, take your million, divide it by 1 minus tax rate, and you get $1,250,000. We're going to have $1,250,000 of operating income to have net income of $1 million. Now we can figure out what our required sales revenue is to break even. And all that is fixed costs divided by contribution margin percentage. We're not trying to find it in units like we did in part 1. We're trying to find it in sales dollars, sales revenue in this particular problem. So if we take our $300,000 of fixed costs and divide it by our contribution margin percentage of 40%, we're going to come up with $750,000. We need to have $750,000 in sales to break even. Over here, for our required sales for $1 million of net income, what we're going to have to do is we are going to have to take our fixed costs and add to it the operating income that we need. So 300,000, let's put this in parentheses, 300,000 plus our 1.25 million in operating income, and we're going to divide that by our contribution margin percentage. And we come up with $3,875,000. So that's the amount of sales we're going to have $1 million of net income. So yes, we're looking for net income, but when you use the formula to find, your required total amount of revenues, you don't use net income, you use operating income, which is why we converted from net income to operating income first. Let's see if this all works out. So, first question is, how many units are we going to have to sell to have $1 million in net income? Well, we know we're going to have $3,875,000 in sales. Let's start with that number, $3,875,000. Well, if we divide that by how much we sell each one for, that's going to tell us how many units we have to sell to get to that particular amount of sales revenue. And we're selling each one of these pillows for $50 a piece, which means that we're going to have to sell 77,500 pillows in order to generate this $3,875,000 in required sales revenue. Our number is going to work out. Well, let's take a partial income statement right here. Let's say we do have that $3,875,000 in sales revenue. Well, if we subtract from that our variable costs, we're going to get our contribution margin. What would our variable cost be in order to get this amount of sales? Well, we know how many units we have to sell to get to that amount of sales revenue. So if we take the amount of units we have to sell and multiply it by the variable cost to produce each one, that's going to give us our total variable cost. We know we have to sell 77,500 units. And up here, we know that each one of these pillows is going to cost us $30 in variable cost to produce. So if we make and sell that many units, our total variable costs are going to be $2,325,000. And because contribution margin is always sales revenue minus variable costs, we're going to come up with a total of $1,550,000 of contribution margin. Let's subtract from that our fixed costs. And our fixed costs have not changed throughout this whole problem. They're still $300,000. Well, if we have $1,550,000 left over to pay our fixed costs, but we only have $300,000 in fixed costs, that means we are going to have $1,250,000 of operating income left over. And we know we're good right now, but let's be thorough and finish this up. From our operating income, we're going to subtract our income tax to get to our net income. Well, what would our income tax be? Well, we got to pay 20% tax on our operating income. So if our operating income is $1,250,000, we have to pay 20% of that. Our tax would be $250,000. And if we take our operating income and subtract out that $250,000 in tax that we have to pay, we see that our net income is indeed $1 million, exactly what the question was asking us to find. So we know now through a little little analysis here, that in order to make $1 million in net income, we're going to have to sell 77,500 units and generate a total of $3,875,000 in revenues. In question 2, we're going to do a target pricing example. Tektronix is about to launch a new affordable scientific calculator into the market. The company is going to produce this product and this product alone in a small facility in New England, and they have the following costs calculated already. For each calculator we make, it's going to cost us $5.40 in direct materials. It's going to cost us $3.60 in direct labor costs. It's going to cost us $1.90 in variable manufacturing overhead, and it's going to cost us 10 cents in variable distribution costs, which means that our total variable cost per unit is equal to the sum of those 4 components. So if we just add all those up, equals the sum of these four numbers right here, we know that our variable cost to produce each unit is going to be $11. Tektronix has fixed costs. They're going to pay $84,000 in rent. They're going to pay $196,000 in administrative salaries. They're going to pay $38,000 in fixed depreciation expense, so they must be using straight line depreciation or double declining or something like that. And they have $32,000 in plant insurance they have to pay. So their total fixed cost is going to be equal to the sum of those four numbers. And we see that Tektronix has $350,000 in fixed costs that they have to pay. Well, Tektronix believes that they have enough production capacity to produce 50,000 scientific calculators, and they're going to assume that they can sell all 50,000 of those calculators that they can produce. So at what price must we sell these calculators if we want to achieve operating income of $100,000, $250,000, $500,000, and $1 million respectively? Let's figure it out. Let's start with earning an operating income of $100,000. Well, we know our target operating income for this particular problem is $100,000. Let's add to that our fixed costs, because by doing so we're going to come up with the total amount of contribution margin that we're going to need to have $100,000 in operating income left over. And our fixed costs, we just figured out, were $350,000 in total. Our rent plus our administrative salaries plus our depreciation plus our plant insurance. Which means we are going to have a total contribution margin equal to these two numbers added together of $450,000. Well, let's divide that by our expected sales volume to come up with how much we need our contribution margin to be for each calculator we sell. And the information just told us that Tektronix believes that they have enough production capacity to produce 50,000 calculators, and they can sell all 50,000 of those calculators. So our expected sales is 50,000, which means to come up with that $450,000 in total contribution margin by selling 50,000 calculators, each calculator has to have a contribution margin of $9. Let's add to that the other costs that we have to cover. To have $9 left over after paying our variable costs, what do we have to sell it for? Well, let's add our variable costs. It's $11 per unit, which means in order to have $9 left over after we recover our $11 in variable cost of production, we'd have to sell the calculators at $20 a piece to earn a target operating income of $100,000. How about for these other points, $250,000, $500,000, and $1 million? Well, we can figure that out too, but instead of doing a table, we can just do it via a formula. And in said formula, what you want to do is you want to start with equals, open two parentheses, and it's going to be starting with your target operating income, in this case $250,000, and adding to it your fixed costs, $350,000. Well, if we divide that by the number of units we expect to sell, which was 50,000, that's what takes us to our target unit contribution margin. And then add to that our variable cost per unit, which was $11. To get to that point, we're going to have to sell for $23. So I just did the same thing that we did in the table, but instead of having the big old table, I just used one simple fast formula. Let's use it again a couple of times. In this part, to get to $500,000 of operating income, let's take the $500,000 of operating income we want, plus our $350,000 in fixed costs. We'll divide that by the 50,000 units we expect to sell, put another end parenthesis, and then add to that our $11 in total variable costs. And that's going to come out to be $28. So to get to $500,000 in operating income, we have to raise our price point to $28 a piece. And then for $1 million of operating income, we're obviously going to have to increase our price by even more. By how much? Let's use the same formula. We have $1 million that we want to have in operating income. Add to that our fixed costs of $350,000. Close your first parenthesis. Divided by your expected sales, which was 50,000 units, and add to that your $11 variable cost per unit. That's $38. So for Tektronix here, if they are comfortable with $100,000 in operating income, they should sell for 20. If they want to get to $250,000, they should sell for 23. If they want to get to $500,000, they should sell for 28. And if they want to get to a cool million, they should sell for 38. What number should they sell for and why? Well, if they think that they can produce 50,000 of these calculators, and no matter what price we sell it at least at these 4 different points, we'll be able to sell all 50,000 that we make, why not sell them for as much as possible? So if we are assured that we can sell every unit that we produce, we're going to charge the highest possible point that we can charge in order to still move those 50,000 calculators.